Oh, look, the peanut gallery's here. What do you guys what do you guys want to do?
Hey Mike, we're gonna do revenue recognition in 3 minutes or less.
Oh, you guys are crazy. Wait, why is the dang door locked? All right, fine. Okay, revenue recognition in 3 minutes or less. Now, just a caveat, we spend about a day on it sometimes, but revenue recognition 3 minutes or less. All right, start the timer. All right, ASC 606, revenue from contracts with customers, is the applicable standard under US GAAP for revenue recognition. Now, important to note here, the difference between gains and revenue. Revenue is delivery of goods or service from your normal or core operations, while gains is something different. Gains are outside the scope of ASC 606. The core principle of revenue recognition is to recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. And ASC 606 sets out a 5-step model. Let's walk through each of these steps. Step 1, identify the contracts with the customer. So, in order to identify the contract, we must have all the following criteria met. 1, the contract is approved and each party is committed to perform. Number 2, each party's rights can be identified, payment terms are identified, contract has commercial substance, and collection of the transaction price is probable. Key question really is, does the contract create enforceable rights and obligations? If the customer has a unilateral right to cancel the contract and not pay anything, you don't have a contract. All right, step 2, identify the performance obligations in the contract. Performance obligations are like promises, okay? And we're going to recognize these promises when they are distinct. 2 criteria. Criteria 1, is it capable of being distinct? And criteria 2, is it distinct within the context of the contract? Now, if the contract requires significant integration, modification, customization, or the goods and services being delivered are highly interrelated or highly dependent on other goods and services, it's not distinct, okay? Now, in this step, we need to consider principal versus agent considerations. That's a big issue in revenue recognition. Now, step 3, determine the transaction price. Transaction price is the amount of consideration to which an entity expects to be entitled for transferring these promises, goods, or services. Entities, you're going to consider things like variable consideration, time value of money, non-cash consideration, consideration paid to a customer. And don't forget about the revenue constraint. Only include variable consideration, not subject to significant revenue reversal. Step 4 is a math exercise. We're going to allocate the transaction price in step 3 to the various performance obligations in step 2. We're going to allocate this transaction price based on a relative standalone selling price of that good or service. If it's sold separately, use that price. If not, you're going to have to estimate it, and that requires judgment. Finally, step 5, we're going to recognize revenue as each performance obligation is satisfied. Really, that is either over time or at a point in time, depending on when control is transferred to a customer. In order to recognize revenue over time, you have to meet one of 3 criteria. If not, I'm sorry, dude. You're going to recognize it at a point in time. Now, obviously, there is a ton of other things we need to consider, and we didn't have enough time for it. That's why we have 70 learning courses on the GAAP Dynamics Learning Library, and why we do revenue recognition sometimes in a day. Good luck with revenue recognition. If you have any questions, call us at GAAP Dynamics.
Hey Mike, so today we're gonna do another 3-minute video, revenue sorry, fuck.